Hi, good morning everyone, and thank you for joining us. This is Ciphr's tax year end 2026 payroll update. It's great to have you with us today, and it's also great to have Claire Warner, our regulatory analyst, with us. Claire, how are you today?
I'm good, thank you.
Very good. Here's a quick look at the agenda. Just in case you're not one of our customers, I'll take you through a little bit about Ciphr's products and services, and then I'll pass on to Claire. She's going to guide us through areas such as rates and bandings for 26-27, new legislative changes for payroll, SSP changes, and looking ahead to later on. We do have time to take your questions today. Please send them in using the Q&A function, and we will get to them as quickly as we can. Just to note around, I know there's been a lot of conversation about SSP, and you might have particular questions about that. Claire has been prepping for that, and we have a bank of FAQs, so if you have SSP questions, it might be advisable just to wait until we've got to that section and see if we preemptively cover some of the questions you might have. This webinar is being recorded, and we'll email that recording to you later today. We'll also provide all the slides as a PDF pack, so you can refer to any of the tables in there as needed, so there's no need to take any notes, or if you miss any content, you can revisit it. In case you're new to Ciphr, here's an overview of our products and services. We offer people management solutions across the employee lifecycle, from recruitment and onboarding through to central HR, and most pertinently for today, payroll software and payroll bureau. Looking at our payroll software in a little bit more detail, it was named SIP's Payroll Product of the Year 2025, and it's an API-led cloud-based payroll solution that integrates with other systems, including our HR software. It's built by payroll professionals for payroll professionals with a really easy-to-use, intuitive user interface, and calculates all the relevant calculations in real time, so you can immediately see the impact on your payroll and pay runs of any changes. Talking about integration, there's a seamless transfer of data between our HR software and the payroll software, with you fully in control of when data is synced across from the HR software to the payroll software. So there's no need to enter manual changes or maintain spreadsheets. You can see the pay runs updated. And just to share with you, we are regularly releasing new functionality into the Ciphr Payroll Cloud solution. Most recently, we added an auto back pay function, which enables you to make simple adjustments in the next pay run. There's no need to reopen closed pay runs, no need to maintain spreadsheets. You're just entering a single aggregated back pay line, and you'll see those really clearly on payslips. So we won't be diving into all of the details of any of that software today. If you are interested in seeing a demo of our payroll or HR software, you can use the button on your screen now to request that, and one of our experts will be in touch later to arrange that with you. And with that, I'm going to pass on to Claire. Thank you so much.
Thank you, Catherine, and yeah, welcome to this session. There are an awful lot of slides in this session, but some of them are purely for your reference after this event. So there are some that I'm going to go over a lot quicker than others, but as Catherine said, you will receive all of these slide deck so that you have it as reference. So we're going to start off with the rates and bandings for 2026-27. We all know that the big headlines were there are no changes. Well, there are a few little tweaks here and there, so we just want to make sure that you are aware of those. So let's start with then there is always national minimum wage rate changes. So the national living wage is going to be £12.71 from the 1st of April, and £10.85 for the 18 to 20-year-olds, and £8 for apprentices and 16 and 17-year-olds. The daily offset rate has increased to £11.10 per day. Now, what I did include on here was the increased percentages so that you as a business are aware of what your costs have increased by. I'm sure you already know that. So you can see on there that the 16 and 17-year-olds and apprentices have had a 45% increase in the last 2 years. What I also need to point out for you is that these increases are deemed to be salary increases for any alabaster calculations that you do. So bear that in mind and go and check anybody that is on SMP at the moment. Then we also have the real living wage rates. Although these are announced in October, their implementation is for the 1st of May. So the October 2025 rate is to be implemented no later than the 1st of May. And the living wage there will be £13.45, and the London living wage will be £14.80. These are voluntary rates that companies sign up for. So again, just to be aware, the next rate we're expecting to come out will be October 2026. So tax changes. Well, income tax and national insurance, the thresholds have been frozen until April 2031. There's been no change to the standard tax code of 1257L, and the reduction in earnings after £100,000, that hasn't changed either. So nothing to report on that section of this deck. There are a few allowance changes. So the married couple's allowance has gone up marginally, as has the blind person's allowance. But the actual tax rates for the rest of the UK, excluding Scotland, remain the same. Scotland, however, have thrown us a little bit of a curveball. So their first 3 rates have been changed. So you will see throughout this deck, anything that is changed is highlighted in that pretty pink. It's mint green. I can't even see the colours today. So the starter rate for Scottish has the percentages have remained the same, but the bandings have changed. So that now goes up to 3,967, and the basic rate goes from 3,968 to 16,956, and the intermediate from 16,957 up to 31,092. The remaining 3 higher rates do not change. Sorry if it seems like I'm going through this a little bit fast, but I want to spend some concentrated time on the things that we know are changing in detail. So no changes to the national insurance thresholds was announced. However, the LEL did change. So that has changed from £125 a week this year to £129 a week from the 2026-27 year. And the relevant weekly and monthly, annual calculations have all gone up in line with that as well. No changes to the NI rates. The thresholds are again frozen. Veterans relief has been extended until the 5th of April 2028. So we will continue to benefit from that. Only the LEL has increased, and Class 1A and 1B still remain at 15%. Just to recap there are no changes. I constantly feel like I'm saying there are no changes, but these slides for national insurance, they are purely for reference. As I said, nothing's changed. I'm beginning to sound like a broken record now. The employment allowance changed last year, hasn't changed this year, but you do need to confirm that you are still eligible if you are claiming that. So all of the criteria remain exactly the same, but you do need to check that you are still eligible if you are claiming that. Statutory parental payments, now they have changed. They have gone from 187.18 to 194.32. So that's covering maternity, adoption, paternity, shared parental, parental bereavement, and neonatal. All of those have gone up to the same rate. And we will be covering SSP in a lot more detail shortly, but these are the weekly rate has increased to 123.25 per week. But there is that change of 80% of average weekly earnings, which I will cover off in the next SSP section. The small employers relief, this one was a bit of a surprise, wasn't included in the budget, but was released later. It has gone from 108.5% last year to 109% this year. Second change in 2 years, having not changed at all since 2011. All the other rules that go with it, threshold, etc., they remain unchanged. And bear in mind that this applies to reclaims for statutory parental payments, but not SSP. SSP remains an employer cost. Student loans, we've had a new student loan this year as well. So we have plan 1, 2 and 4 have all changed. So plan 1, the threshold has gone up to £26,900. Plan 2 has increased to £29,385. And plan 4 for Scotland has gone up to £33,795. The postgraduate rate of 21,000 hasn't changed. And the interest rates, the percentage at which they are paid, the repayment rate hasn't changed. We have got the introduction of the Plan 5 for England from April 2026, starting with a threshold of £25,000 and a repayment rate at 9%. When we come to it a bit later, there's another section that mentions consider this because it's very close to what minimum wage might be. And even doing a little bit of overtime or a few extra hours might tip people on a Plan 5 into that repayment rate. So worth considering. And then workplace pensions. No change to the thresholds that we did think that there might have been some changes to these, but there's nothing that's been published. So all remaining exactly as was. But do note that the lower level is not the same as the LEL for national insurance. And we just need to be aware that there will be more employees hitting those trigger points. And a little bit of change for company cars and vans. So those, the fuel multiplier then has gone up to £29,200 for this year. And the company van has gone up to £4,170, with the van fuel charge going up to £798. And breathe. So, and there are also some changes here. I've also put on this slide for you the changes to the EV rates for the next coming years, just to help you plan a little bit around cost implications for employees that are maybe looking to move on to the EV market as part of your benefits offering potentially. So they're all listed there for you, just as a guide. Quick reference guide we're looking at. Advisory fuel rates, these change quarterly and they've changed from the 1st of March. So we've included that information on here for you too. You will see not exactly a significant rate change. So in fact, I don't think there was anything much changed other than the public charging rate for the electric vehicles and the LPG rates. So again, if you use those rates, you will know about them. But again, simply there for reference for you. Okay, hopefully that was a fly through of all the rates and bandings that you'll need to know about for the new year. I'm now going to give you a little bit of an insight into the Employment Rights Act impact. Not going into any detail. If you didn't join us for the Employment Rights Act webinar last week, I do think it was only last week, we can definitely supply you with a link to that webinar recording if you would like to catch up with it. So there are some changes to parental leave. These are the ones that particularly impact payroll, although they're not payments. So they're changes to the entitlement for leave. And for that, it means that we've actually had to look at changing the the warnings when we are setting up an absence within a payroll system. So the absence warning would have said previously not entitled until they have 26 weeks of service, for example. We've relaxed that down to say this is now a day one right. Are you sure you want to go ahead with this? None of these changes affect the payments, so that's very different. We need to understand that. So in theory, this shouldn't have an impact on payroll, but it's always good to know. Paternity leave is going to become a day one right from the 6th of April. So anybody can give notice from now for SPP changes. And there's no change to the length of it or when that can be taken. The only change, other than it becoming a day one right, is that it is now not restricted to when it can be taken around shared parental. So that restriction has been removed. So again, that's a bit more flexibility for families. And parental leave, well, eligible parents will have the right to take unpaid parental leave after a year's service currently. That is going to become a day one right as well. And that's literally all I'm going to say about the Employment Rights Act right now. But as I said, if you do want to pick up on what we said last week, please feel free to catch up on that webinar. There's a whole hour of employment rights that you can listen to. So I'm going to take a bit of a deep breath here and say we're now going to be looking at SSP and the changes for SSP. This has been the hot topic right the way through. Every customer, there's queries left, right and centre. So I'm going to hope that I can cover off a lot of this now for you. Again, there are some Q&A. There's some Q&A time at the end, and there are a lot of FAQs that I will try and address as we go through, but I have put them in slides so that you can look at them after. Right, breathe. And so the summary, what's going on? SSP will now be payable from the first day of absence and paid from day one for all employees. The link to the lower earnings limit has been removed. And that then means that all employees, regardless of their earnings, will be entitled. Those earning below the LEL will receive 80% of their average weekly earnings. All payments will be capped at the flat statutory rate for SSP of 123.25. All the other exclusions remain, and there are transition rules. Now, I'm going to go into all of this in a little bit more detail for you. But in summary, what does this mean? Absence reporting and processes, return to work conversations, they're going to become increasingly important. People coming to work when they are ill and kindly sharing their germs would be my take on that, because actually I don't want your germs, I'd rather you stayed at home. But some people have felt unable to stay at home when they have been ill because they wouldn't have got paid. So again, that may increase. People may be staying at home more when they are ill. We might need to be considering, or payroll might not, but certainly your organisation might look at how you cover temporary absence in a different way. But also clear communication, I think, is going to be the key. This is all over the media, so it is very important that we have the right level of comms within our organisations so that employees know what they are entitled to. This doesn't change any of your occupational schemes. The only caveat I would say to that is if your occupational scheme is based on SSP, you might want to revisit and make sure that it is still valid and makes sense. So let's have a look at what is going on. First thing, regular question. Has the average weekly earnings calculation changed? No, not at all. It is exactly the same as it has been before. Bear in mind, the SSP average weekly earnings is different from the average weekly earnings that we use for parental leave or holiday pay. But again, how do you do it? That hasn't changed. What if somebody hasn't worked for you? You take their expected earnings. What if they've only worked for you for 4 weeks? You take the average over those 4 weeks. If you don't have 8 weeks, you take what you have as available. And it's the 8 weeks prior to the first period of absence. None of that has changed at all. All the other exclusions remain the same. So if the employee has already received their 28 weeks of SSP, there's not a reset on the 6th of April. That doesn't mean they get another 28 weeks. If they have continuous linked periods spanning 3 years, that remains. If they're in receipt of maternity allowance, if they're in legal custody, not that I'm sure they would tell you. But the other key one to note is that workers under IR35 are not eligible for SSP. They're workers, not employees. So just a note on that one. Other than that, all the exclusions remain exactly the same as they have been. So then what are we talking about? If nothing's changed, average weekly earnings hasn't changed, the exclusion criteria hasn't changed. What about waiting days and link periods then? Waiting days have been reduced from 3 to 0. So by that we mean we no longer start paying on day 4 with 3 days unpaid. We pay from day 1. A PIW previously or currently, I should say, requires 4 consecutive days to be formed, and that's where the link period would be generated. That's now going to be 1 day. So 1 day's absence will link to a previous period, whereas our ad hoc days previously were just ignored because they didn't trigger SSP. They will now trigger SSP, and those 1 days will be part of that 28-week entitlement. So we may need to look at how we record odd days of absence, because historically we may not have chosen to do so. Linked periods are going to be easier to link. It's still that 56-day period, so it's still that 8-week period, but because it now links from a single day, if somebody has a day off for a migraine every 6 weeks or so, it is continually going to link back to that very first period of absence. Just something to bear in mind. It's going to be harder to break that linking. What about the payments then? That's waiting days and that's linked periods. So payment from day 1 of absence. Yes, absolutely. Anybody that is absent will be entitled to SSP from their first day, assuming it's a qualifying day. So we put that caveat in, and I've got a couple of examples to show you. The removal of the link to the LEL. So no longer are we reliant upon somebody earning above the LEL in order for us to say, yes, we're going to pay you SSP. Now we need to do the average weekly earnings calculation and say, is it above 123.25? If it is, we're going to pay the flat rate. If it isn't, we're going to pay 80% of the average. Again, this is now paid daily. So we take that average and we divide it down by the number of qualifying days for the employee in the week, the same way that we would always have done for daily rates for SSP. The rounding is up a penny, so it's always going to be in favor of the employee. And the rounding is done at the end of the calculation. So again, your software should be coping with all of this for you. Payments are always going to be capped at that 123.25. So it doesn't matter if you earn £100,000 or £10,000, you are only ever going to get 123.25 as the maximum. But if you aren't earning at that level, so if you have, for example, earn £100 a week, previously you would not have been eligible for SSP. Now you will be eligible, but you will get 80% of your average weekly earnings, divided down by the number of qualifying days. Hopefully that's clear. I can see some questions coming in, but I just want to get through this bit before I get to the questions. There are also going to be some transition rules that apply to those whose sick absence spans the 6th of April. And there are specific transition rules, so I will cover those for you as well. So I've got an example here for you. Hopefully you're all familiar with the days of the week. We know statutory sickness starts on a Sunday to Saturday, but please note, these changes come in from Monday, the 6th of April. All other statutory payment rates change from Sunday, the 5th of April. And also note that the 6th of April this year, just to make life a little bit easier, is a public holiday in the UK. So the example I have here is somebody is a Monday to Friday worker. They're off sick for a full week. Currently, they would have to serve 3 waiting days and be paid just 2 days SSP, which would give them, and I'm going to use the new 26-27 rates because it's simply easier for comparisons. They would be getting £49.30. However, with this change, there are now no waiting days. They will be paid 5 days, so the full week's SSP. They will be entitled to 123.25, assuming they're earning above. And that's an increased employer cost of £73.95 for one employee's absence. Let's take that through to a part-timer. So I've used an example here of a part-timer who works Tuesdays and Wednesdays only. They're off sick for 2 weeks. Currently, they would have to serve 3 waiting days and receive 1 day's SSP. So they would be getting, on New Year rates, £61.63 for their 1 day's absence, albeit they've been off for 2 weeks. From the 6th of April, they will be getting 2 full weeks of SSP, which will entitle them to £246.50, again using the new rates, an employer increase cost of £187.12. So whether you budgeted for this or not, you need to make sure that those in charge of budgets are aware that there are some increased costs coming through. And I'm just going to have a quick look at the Q&As and just see if there's anything in there. Right, I will come back to those, so bear with me. Okay, so some transition scenarios for us. So HMRC have acknowledged that there will be people that are actually off sick over this transition period, the changeover between the 5th and the 6th. So what happens? So any employee that's earning below the LEL before the 6th of April would not have been entitled to SSP. So they might be off sick but receiving no payment. They will be entitled to SSP from the 6th of April moving forward at the average rate of 80% of their average weekly earnings. The average weekly earnings calculated based on the period before their current period of incapacity for work started. If somebody is serving waiting days on the 6th of April, so for example, they were sick on the 4th, 5th, so that they would have had potentially, if they were on a 7-day working pattern, or the Saturday and Sunday were their normal working days, for example, they would have been serving a waiting day on the 4th and the 5th, the 6th, and would have been paid from the 7th. But with the change, no waiting days are served from the 6th, so they will be entitled to payment from the 6th of April. They won't be paid for anything prior to the 6th of April. And there is a really small potential, well, the government are telling us that it's a small potential cohort of individuals that are continuously sick, which started prior to the 6th of April and will continue past the 6th of April. There is potential for these employees to become worse off under the new 80% rule. So the 80% rule, just to recap, says we're going to pay you 80% of your average weekly earnings or the flat rate, dependent upon which is the lower. So there's a small group of people that if we use and apply that rule, if they earn an average weekly earnings of up to £154.05, quite specific, but £154.05, they will be worse off under those new rules. So what the government have said is, under the transition rules, we're going to protect those people. If they are already receiving the flat rate of 118.75, they will continue to receive the enhanced flat rate, and we will ignore that 80% calculation. So they will move from 118.75 to 123.25 with effect from the 6th of April until they break that transition period. Now, what it takes to break that transition period is a single day's return to work. So somebody that was receiving 123.25 could potentially be worse off by coming back to work for a day, because when they went off again the next day, they would be back to being paid 80% of their average weekly earnings. Just something to bear in mind. The transition rules will remain. Sorry, I'm really sorry, my door has just gone, so could you just bear with me a second?
Hi everyone, sorry about that. We will get Claire back on the line shortly, and I am not qualified to be running through some of these questions, but thank you all for the questions about SSP. I rest assured we do have some slides coming up later, which I hope will give you some examples about these, talking about continuous sickness with whether that's before with AW before or after 6th of April. I'm waffling to fill time.
That's
so
okay. I am so sorry. It is just typical, isn't it? But he does not go away. He just keeps ringing the doorbell. So
okay. Thank you.
Thank you. So yeah, many apologies for that, people. So that small cohort is something that we just need to be aware of, that they could be worse off. So the next few slides, they're all transition scenarios, and I'm going to flick through them because you will be able to read them in your own time. But I'm keen to get through and come to your questions at the end. So these are scenarios that have been provided by HMRC. I've tried to put them into a context, which means you can follow them through. But they're all covering off the examples that I've just given. So I am just going to flick through them for you. The one thing I do need to say is that I have also put in a flowchart for you, which I will show you shortly. So the new SSP rates then, additional information, new SSP rates, 6th of April, not the Sunday, Monday. Why? Well, that was the question I was asked. Why? And I went, well, somebody clearly didn't know that the 6th of April isn't the normal change date for statutory payments, but we are where we are. So it's the beginning of the new tax year. It kind of makes sense, but it doesn't. All other statutory rates change from the 5th. So bear in mind that if you have somebody off sick on the 5th, they get the old rate, and from the 6th, they get the new rate. Transition protection rules remain for a maximum period of 28 weeks. That takes us through to the 17th of October, a bit specific, but that's 28 weeks from the 5th of April, which is the last point at which somebody could have started under the old rules to get transition protection. And SSP hasn't really been, I want to say it hasn't really been enforced previously, but the enforcement now is going to be under the new Fair Work Agency. And I'm going to discuss that a little bit more as we move forward in another slide. But bear in mind that they are targeted with enforcing SSP. And because these rules now impact every employee, there could be challenges more than we have had previously. Okay, this is the flowchart that I put together, and my team have found it quite useful to print it out, stick it on the wall, and actually go, well, yeah, okay, what happens if, were they off sick before, yes or no? If they were yes, where did that follow through? Hopefully that makes sense for you. I want to say I tried to make it as simple as possible, to make it something that's an at a glance, because some of these rules are a little complicated. And I will also say that we do not have full guidance as yet. There are still gaps in the guidance that have been provided. So I'm sure we'll pick up on that when we get to the Q&A bit. Okay, I've put together 3 slides of FAQs, which will be in the slide deck. I will come back to those, but I want to go on with the rest of the presentation first for you, so that I make sure that we cover everything off and then come back to it. So although there may be answers in there, I will come back to your individual ones as well. I want to look at what else is new for you, just to make sure that we are comfortable with what we're expecting and what's coming next. So what else is new? I've already mentioned Student Loan Plan 5 is new for this year. Any employee earning £30,000 is going to pay £450 annually in their student loan repayment. I've put a note down the bottom there that says employees working 37 hours per week on national minimum wage will earn £24,454 per annum. That's really close. It's not going to take an awful lot of overtime. If they are on a 40-hour week, they're already above that threshold and will start paying £129 a year in that student loan. So that threshold is quite low if you consider that it's impacting those on minimum wage already. I know there's a lot of media hype around what they're going to do about student loan thresholds. Are they going to make any changes? I think that's a watch the budget in the autumn and see what they're going to do from 27. I think, yeah, my opinion is neither here nor there. Let's wait and see what happens. Statutory leave. So there's been the introduction this year of parental bereavement leave in Northern Ireland. And you might be sitting there scratching your heads and going, but we've had that in the UK for ages. We have. It was introduced a few years ago within the UK. However, Northern Ireland, their assembly was actually suspended at the point that it was introduced into England, Scotland and Wales. So they're playing catch up a little bit. They brought it in. It's their Parental Bereavement Leave and Pay Act, Northern Ireland 2022. That's a bit of a mouthful, but comes in 2 phases. The first phase mirrors what we already have in the rest of the UK. However, phase 2 is the key one here. These don't apply to the UK, and I will caveat that with saying yet. They've gone one step further. So parental bereavement pay is a day 1 right for stillbirth and child deaths within a year. So that is then going to be removing that 26-week service period. This only applies to your employees that are living and working within Northern Ireland. They have also included miscarriage up to 24 weeks. All part of the Employment Rights Act proposals, but they're not coming into the UK just yet. And payments for these elements need to be reported separately on RTI. So they have to have separate pay elements and are subject to the employer paying Class 1 national insurance for these employees. But if you are required to pay them, make sure that you pay them on a separate pay element so that it is reported correctly on the RTI submissions. What other changes? Again, some quiet changes, and I want to say these are quiet because they didn't really hit the media overly much. The employee's ability to claim their working from home relief via their tax code with HMRC is ending. Now, that's not to say there's no relief available, because employers can choose to continue to reimburse tax and NI free, but it has to come through the employer. There's some new and extended exemptions to some benefits, for example, eye tests, flu vaccinations, and working from home equipment. Historically, they couldn't, no, historically, if the employee was reimbursed, there was an implication, and the requirement was for the employer to arrange the eye test, for example, or the flu vaccinations in order to be able to provide it as a benefit. That has now been removed. So we can safely reimburse the cost of these things via our expenses policy. And for anybody working in a payroll only service environment, tax advisor registrations will open from May and be open until February next year. Any payroll service only provider that isn't registered under any other schemes, so for example, they're not part of an accountancy practice, will need to be registering under these rules. There's little guidance out there yet. There is some, but it is a bit confused. But do watch this space, because there will be more guidance coming. It isn't going to be a quick registration process, I will say that. It does look as if it could be quite convoluted. So it is certainly something I would start looking at sooner rather than later. That's not to say you have to register on the 18th of May. What I will say is you have to be registered by the 18th of February 2027. The Fair Work Agency I've mentioned, it comes into being, for want of a better description. It is being set up from the 7th of April. It's a new central enforcement body for employment rights. It will cover enforcement of national minimum wage, statutory holiday pay, and SSP, as I've already mentioned. It will pick up and manage the employment agency regulations, and it will have greater powers to inspect, investigate, and enforce. The theory is it is there to support compliant workers and encourage those that are non-compliant to become compliant. The cynical me says they're likely to have a target to say you need to bring X amount of money in via fines, but that's me being cynical, and I accept that. So what are the actual implications? More inspections are likely to be happening, quicker enforcement, and bigger, larger consequences. So we will need to consider greater accurate reporting. There'll be less tolerance for inconsistent or poorly documented decisions and processes. There'll be clearer guidance provided, but the consequence of the clearer guidance is going to be a higher compliance expectation. So it is one to watch out for. And because they are going to be a dedicated force for enforcement, it is likely that we will be seeing quite a bit of them. So sorry, I've been doing so much talking. Looking ahead then, let's have a look and see what is coming next for us. Payroll never stops, so there's a few bits. What I think we should be looking at now is potentially some cost examples for your dependent upon your employee demographic. If you have a lot of casual workers, if you have a lot of part-time workers, if you've got a lot of low paid workers, for example, you might be looking to do something around the demographics of budgeting for those odd days of SSP costs, which would not have hit your budgets previously. You do need to be looking at any alabaster consequences of the minimum wage changes. So go off and check who's on maternity and if it impacts their payments. And also look at the changes on salary sacrifice and OPRA arrangements to ensure that you are still compliant under those rules, bearing in mind the change to minimum wage and the fact that we know we can't take salary sacrifice below minimum wage. So some of those agreements may need to be adjusted. What else to look for during 2026-27? There are going to be some more changes to the Employment Rights Act coming through. They're going to come through. There's a schedule for August, October and January. So before we get to this time next year, we will have 3 other things. A lot of this is going to be around changes to trade union, but there is a lot of other stuff in there as well. Be aware that statutory parental leave is currently undergoing a major 18-month review, which started last summer. So through the year, I am actually expecting to get some feedback from that as to the proposals of how they're going to revamp statutory parental leave. That's certainly something to be looking out for. And of course, we have the joys of payrolling of benefits in kind, which is going to be foremost for our next year. So that said, we also need to look out for some changes that we know are coming in October. So the Fair Pay Agreement for Adult Social Care negotiating body is coming into being in October. So if you work in the care supply environment, you might need to keep an eye out for that one and that one's implications. But also if you work in any hospitality arrangements, tipping laws are being tightened from October, and they're going to follow a very similar process to that we employ for auto enrolment, in that they will be subject to 3-year renewals. So they will need to be renewed and confirmed every 3 years on a 3-year cycle. So that's worth keeping your eye on as well if you work in that sort of organisation or business. Payrolling of benefits in kind. Now, we keep on about this. We've been keeping on about this for a long time. It is coming in from April 2027. We now have interim guidance and legislation available. There is some conversations that are going on in the payroll arena that is saying it's just an extension of what we've been doing since 2014. It isn't. It is a massive change. There will be a new end of year process. All benefits, with the exception of accommodation and employment related loans, will be mandatory through your payrolling. Those 2 items are voluntary, and you can register to voluntarily payroll them up until April 2027, sorry, in the wrong year. What's the impact? We know that there's going to be some changes. There may be configuration changes. There may be additional data. No, that's a lie. There will be additional data that we need to provide on the RTI submissions. Those RTI submissions are significantly different. There are, I think at last count, over 200 additional fields that may need reporting dependent upon your specific benefits that you provide. And a big one that might have slipped through the net and you've not been aware of is the Class 1A NIC will become a monthly cost, not an annual cost. So that will need to be configured into your budgeting. Again, cash flow, budgeting, planning, communications, they're all going to have a wider impact on your business. But please, if you want to know more, join us for a webinar on the 16th of April, where we're going to take a much deeper dive into the changes for benefits in kind. So I'm going to take a breath for a minute, and I'm going to have a look at the Q&As that are coming in. And in fact, what I'm going to do is I'm going to take the slides back to the Q&A slides and leave them on there. We'll leave them on there while you can have a read while I look at some of your questions coming in. From when do we, right, let me go to the top. So slides are coming out. Catherine's all over that one. The year-end checklist, we have published that today. So for anybody that wants that, Catherine's put a link in. Thank you, Catherine. We have an employee who planned paternity from the 1st of April, but he was not eligible for pay. It's a day one right to unpaid. It's not a day one right to paid. So if he's not eligible, he's not likely to be eligible for the new year. It depends when his employment started. Hopefully that answers that one for you. How does this apply to those who've already an SSP 1L, a 1 for? If they are in receipt of an SSP 1, you don't need to be worrying about them, because they will have actually been transferred over to the benefits system for payment. And anybody in receipt of any benefit, and I think it's in the I want to say that 85 days prior are excluded anyway. So if you've already issued an SSP1, you need to wait until they come back to work, and then it will make a change at that point. How does the removal of waiting days affect employees where the sickness periods start at the end of March into April? Hopefully the transition rules will have enabled you to understand that. But if they are if they are currently off sick and receiving SSP, they will continue to receive SSP and at the rate I explained in the transition rules. Will linked periods be backdated or only linked from April? No, there's no change to how the linked periods work. That's absolutely the same. So they will be, if they go off sick in April and it links within 56 days to a previous period of absence, then that's where your calculation is taken from. So again, no changes to linked periods rules. Said that this is not applicable to casual workers. So from the 1st of April, do we carry on with current rules of having waiting days? There are no waiting days. So in order for, and casual workers, I should say, is one of the gaps in the guidance that we have. So there is no concept of waiting days. If they are scheduled to work, then you should treat them as you would have done before, but pay them from day one. If they aren't scheduled to work, casual workers are a little bit different because effectively they don't have an employment contract. But if they are scheduled to work and they phone in sick on that day, then they are entitled to SSP at a rate of 80% of what they would have earned on that day, or the average weekly earnings. But if you've not got any earnings, that's a bit difficult. So we are waiting for additional guidance to cover casuals. But what I would say is that no, you don't carry on waiting with waiting days. They literally, they are paid from day one. If they're scheduled to work, you should be paying them. For a casual worker who hasn't received any pay in the relevant period, so the average weekly earnings comes in at 0, they would not be paid SSP. That would be the same for somebody that is sick on day one of an employment contract. It's what they would be scheduled to work on that day. Hopefully that solves that one for you. Our employee exhausted their SSP in November 2025 and they're still off sick. What happens to the employee in April if they remain sick? Nothing. There's no reset. If they've had their 28 weeks, they are that there is no reset. If they should have had an SSP 1. However, looking at this, they've exhausted their SSP in November and they're still off sick. They will have been, they will have had an SSP 1 and they will have been transferred to the benefits system. So there isn't a requirement for you to pay. However, if they do come back, there's a different calculation and there's some slightly different transition rules. And I can supply those with you if you want to drop me an email. I can send you a link to that. SSP transition is that 80% of the average weekly earnings include the previous SSP payments or based on the basic pay. Not 100% sure I understand that question, so let me reread that. For SSP transition, is the 80% of the average pay includes the previous SSP payment or based on the basic pay. You will have done your 80%, no. When they first went off sick, you will have done your average weekly earnings based on the 8 weeks prior to their absence. Assuming they are still off sick, that rate will either be the flat rate, which will continue until they return to work, or they will have been excluded because they were below the LEL, in which case they will be entitled to 80% of the average weekly earnings at the point it was calculated and seen to be below. Because if you do it from the 6th of April and they've been off sick but have had no payment because they were below the LEL, it will come out at 0. I hope that makes sense. I'm sure it does, but if it doesn't, please drop me an email and I'll happily try and pick that up with you. If someone works in the morning and then is off sick in the afternoon, no SSP is to be paid. You cannot pay SSP in part days. That rule has not changed. I haven't got any examples of casual workers who go off sick at the moment, but I can certainly see if I can pull some together. But as I said, there is no specific guidance from HMRC on casual and 0 hours workers at the moment. So that would be my take on what I would do, but I'm more than happy to look at that for you. Again, drop us a text message, an email, and I'll see what I can do with that one. Would the impact of changing to voluntary payroll benefits halfway? What would be the you generally don't change to voluntary payrolling of benefits partway through a year. That would be quite unusual because you would then have to do half a P11D and half payroll. So that would actually effectively double your workload. I'm not sure why you would do that. I would suggest that you do it from April, if at all possible. You've still got time. You can still register if you need to for April this year. So we don't need to pay for... So we do not need to pay for a remainder of 28 weeks. SSP is an entitlement for 28 weeks. So yeah, if there's a payment due, you do need to continue with that payment. Can we have a mixture of payroll benefits in kind and P11D? You can, but it just makes life a bit more complicated. Sorry, I should have read that question out. Can you have a mixture of payroll benefits in kind and P11D benefits in kind for 26-27? Yes, you can. And it's not uncommon to put cars on a P11D and payroll the other benefits. I'm aware that we are coming to our hour, so this one seems to be the last one. How many days SSP needs to be paid if casual employee is sick? 3 days on their 0 hours contract on a regular 3 days. Yeah, I think that's all the questions, Catherine.
Yes,
I'm
I think
not 100% sure, but thank you.
Yes, that seems to be all of them. Thank you very much. And thanks everyone for your questions. Hopefully you found today's session useful and that you've got a lot of clarity on the upcoming changes for the new tax year, as well as looking ahead to those BIK changes. Do join us if you can and wish to next month as we dive into that in a little bit more detail. The link is in the chat. You'll also be able to find that on our website soon, and we'll put a reminder of that webinar in the follow-up email after today, along with the PDF of the slides and the recording from today as well. Thank you, Claire, for all your expertise. That was very professionally
Thank you.
delivered.
I'm sorry it was so much of me talking, but hopefully people got some benefit out of it.
Yeah, we got through it all in the time allowed, so that's awesome. If you would like any more information about any of Ciphr's solutions and services, so our HR software or our payroll software, for example, please opt in using the exit form that you'll see when you leave this broadcast, and please also take that opportunity to leave us some feedback, and that helps us do better next time. Otherwise, thanks again for joining us, and I hope you have a great rest of your day. Take care. Goodbye.